What is driving the growth in GMV right now at Affirm?
It's a number of things in terms of the pieces that sum up, but the fundamental trend here is a consumer preference away from revolving credit accounts into better alternatives to still get the things that matter to them in a way that's it's honest and transparent and good for them.
So the company is growing and it's posting healthy growth. The stock is down 20% year to date. What do you think investors are reacting to?
You know, we've learned the hard way over 5 years of being public not to spend too much time thinking about the short term on the stock price. If you look back over the past 5 years, we've certainly seen lots of highs and lows. We're focused on building the best business, and we know that if you do that, the stock price will eventually reflect that. The things going on in this business right now are just really incredible. The past 90 days have really been a clinic in just making big leaps forward in what we're building. Everything from our new distribution opportunities with Intuit in North America to VMO2 in the UK, as well as the business that continues to just post some killer metrics. Not to mention our card, which continues to be a real bright spot in the business.
Right. Talk a little bit more about the growth in the card. I mean, where is that coming from?
The card is the best way for consumers to repeat on Affirm. It gives all of the benefits of the financial product that we have built that provides certainty and control to the consumer. And we deliver it on a piece of plastic. And consumers find us at the point of sale, and then they're given an opportunity to onboard to the card, and they're taking it up in really strong numbers. The growth in the card was 160% year on year this quarter. We now have 3.7 million active card holders. And all that's done just leveraging the existing network. We're not doing anything to go out and acquire these users that's inorganic or an acquisition based approach to it. We're literally engaging the consumers we've already seen with the better product in the card. It's been a huge driver of growth and re-engagement with consumers on the platform. And it's really cool to see the consumer's preference for these honest financial products showing up in their preference for using the Affirm card.
And so just remind us of the company's trajectory here. So it started with buy now, pay later, and now the card is it's a normal credit card that we're all used to?
No, it's very different. It is a piece of plastic, and so you can walk into a store and just put your chip in there, and the modality feels a lot like you're using a card that you're used to, but the financial products behind it are fundamentally different. It has two modes. You can pay now with a linked bank account or with the Affirm Money account, or you can pay over time, and we
Hmm.
turn those transactions that you are whether you're buying a jacket in the mall, we turn that transaction into an installment loan like any other loan that we have in our portfolio. And so the consumer can walk into a transaction and understand that they have complete certainty over the cost of credit of that transaction by asking for approval before they swipe the card. The consumer knows exactly what they're going to be paying to complete that transaction. And it's fundamentally different than what a consumer does with a credit card, where you kind of swipe it and you maybe don't exactly know what's going to happen in the future. You're playing a little bit of roulette with your financial life. With our card, we give you complete certainty.
So are you taking share away from the legacy credit card companies with these products? Not just the card, but the buy now, pay later offering broadly. Is it about taking share or is it about getting business from people who may not have otherwise been as integrated into the financial system?
I think it's definitely the former. I think if you think about the total balance of revolving debt in the United States, it's $1.3 trillion of revolving balances. It's a gigantic number, and consumers are desperate for alternatives that don't force them into this compounding and revolving treadmill that the credit card business models are built on. And they're preferring alternatives that give them certainty, control, and yeah, we are really intentional around making sure we're able to give credit to a wide set of folks. It's important to us in our mission that we're serving a wide set of consumers. But the vast majority of our consumers are people who have credit cards available to them, and they're preferring Affirm over the revolving credit accounts.
And how is the breakdown of your customers changing right now in terms of levels of income or customer profiles?
Yeah, I think a lot of people are surprised to hear just how incredibly median our consumer is at Affirm. We don't really skew heavily high income or low income. We don't skew high credit or low credit. Our consumer is very representative of the American consumer. The American consumer is pretty well employed. They're highly engaged in the economy. They're able to stay current on their obligations, and that really does reflect the same things that we see in our consumer data.
And so I want to ask you this question that came up at a dinner that I was at earlier this week. We were talking about consumer sentiment and the economy at large, and the idea of the K-shaped economy came up, and people were talking about where it's headed. Are you seeing that play out in your data at all?
No, we aren't. I think there's two things that we look at when we think about what our data says about the health of the consumer. The first thing we look at is, are they engaged? Are they out engaging in commerce, completing transactions? And as you can see, last quarter we grew GMV 36%. It's a really strong growth rate. That's a highly engaged and active consumer. And then we look at the credit performance. Are consumers paying back on time? Are the cohorts of loans charging off at the same rates that you would have expected and consistent with prior years? And all of that is very much in line. I would hesitate to extrapolate what we experience at Affirm to the broader economy only because our product is different. Our product has several features in it which actually engineer, we think, better outcomes for the consumer. For example, our products have a fixed payment schedule that amortizes very, very quickly. So consumers who enter into our transactions are much more likely to get out of them much more quickly than if you were revolving on your credit card. That makes these comparisons from what our product and our consumer is doing to the broader unsecured consumer asset classes a little bit hard to extrapolate. But for what we see with our consumer on our product, it's really healthy, and you don't really see those signs of the so-called K-shaped economy.
I want to ask you very quickly before you go about the intersection of AI and the financial system. We talked to a lot of founders of a lot of AI startups on this show, and I'm sure there are a lot of founders out there that are working to integrate AI into the financial system. I know there are big companies like Affirm that are doing that. But as it relates to startups and emerging technology, how which pockets of AI helping the financial system are you really focused on right now, and are you guys investing in a lot?
Yeah, we're investing an incredible amount. We spent a lot of time talking about this a few quarters ago. AI is all over our business. It's first, we're a software development company, and so any of the advances that we have in AI enabled development is certainly impacting our ability to ship code quickly. Those impacts, I think, are incredible and very dynamic. Every month, the industry is making big improvements. We also have products that leverage these models in order to target better offers for consumers or optimize our merchant financing programs. And we talk about how those drive incredible and much better outcomes. The real insight there is that the quality of models just goes up everywhere. And if you can, any problem that you have, it's a math problem, it's a modeling problem, the more you can leverage these Gen AI capabilities, the better off you're going to be at sorting risk, identifying and targeting offers for consumers, and building better programs. And of course, we are in the business of building models. Everything we do at Affirm is software, and most of what we do has a model behind it. So we're really beneficiaries of the tailwinds of these just fundamentally better models.
So it sounds like for you guys, I mean, really, it's the back end of the financial system and being able to sort through risk, being able to sort through how much credit to give people, which customers are worthy of which credit. I mean, it's really all that back end calculation, which is what AI is making a difference for you right now.
Yeah, but also in what consumers are offered. And so if you're a consumer, the more that the offer presented to you fits you, the more tailored it is to your financial situation, the better off that you're going to be. You're going to have a higher probability of a successful transaction. You're going to have a higher probability of a happy path. And our models are getting better at pointing offers to consumers that are going to resonate with them. Additionally, also for the merchant side, the programs that they offer can be optimized with better modeling. And again, every part of our business has a model to it, and all of them are getting better.
And very quickly, are you hiring any less this year because of AI?
The opportunity at Affirm is just so enormous. I mentioned the $1.3 trillion of revolving debt that's out there. It's so enormous that we still need more resources, but we are seeing material improvements in productivity of our engineering team because of these tools.
Got it. Great. Well, Michael, I want to thank you for coming on. That is Michael Linford, Chief Operating Officer at Affirm here on TITV.